Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 1st, 2025. Happy February! Hey, I hope you're doing well. I hope you had a good week of trading and that you're enjoying your weekend. I appreciate you coming to my weekend review podcast. I hope you're going to find it helpful today. Um, Still here in Santa Marta, Colombia, so just wanted to put a little plug in. If you ever have a chance or opportunity to come to Santa Marta, Colombia, I think you would really enjoying my time here. But we'll be coming back to the States in about 10 days. So, yeah, interesting market this week. Big reversal on Friday, but we'll get into that. And the format of the podcast is as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have and all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences were, um, how I position size, how I place my emergency stop, how I place my end of day stop, how I'm going to take partial profits if the market goes in the direction that I want it to, how I'm going to tighten my stop up if we get to trailing stop level, and then significant overhead resistance levels where I will completely exit the trade, and I'm short as well. So if we go down certain levels, exiting the trade as well. So I hope you're gonna find it helpful. Kind of get inside of my mind as far as how I look for trades and how I am going to manage them going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to, one, be patient, two, when you enter the trade, follow the process that you set out. It's really that simple, everyone. But the emotions, the up and the down of the markets while we're in the trade can sometimes shake us out of the trade. But if you have a good trading process, listen, there's no magic trading process, nothing magic about what I do, nothing magic about what other traders do. But the key is that you need to follow that process. And really, that comes down to trading psychology. So I like to talk about that. Always helpful for me to teach it. Hopefully, it's going to be helpful for you to watch it as well. And then after that, I have gone down through my master watch list. I do that every Friday night. And I go down through each one, both on the daily time frame and the weekly time frame. And when I look at the charts, I go, okay, I'm not in any of these positions. If I wanted to be in these positions, where would that level be? And I look for important levels, RSI levels, moving average levels, previous support levels, uh, double bottoms, bullish divergences, double tops, bearish divergences. I look for a confluence. And if I can look at a chart and go, okay, boy, if it got down here, that would really be the sweet spot. That would be the ideal spot to get into the trade. Now, sometimes it won't go there, but sometimes it will go there. And if it gets to that level, that on the weekend that I've gone through and looked and go, okay, next week, if it gets to this level, I have an edge there. That's a sweet spot. That's an edge, and I will consider taking the trade if it gets there. And I've been trading for almost 30 years now, and really it works. But the key is, back to trader psychology, the key is you have to be patient and wait for that trade to get there. Not almost there, right? But to get there and do what you wanted it to do. And if it does that, then consider taking the trade. It doesn't mean that it's going to be a profitable trade by any means, but it increases your chances dramatically. In trading, that's what it's all about: increasing having an edge, increasing the probabilities of, hey, maybe 65% of the time this is going to work, 35% it's not going to work, and having a good risk to reward ratio and all that other stuff. So I have identified some potential trades next week that are getting to some interesting levels. I don't know if they'll get there, but if they do get there, then I'll consider it. But I'll go over each one and explain what is going on with that spot and why I will consider taking the trade there. So anyway, I hope you're going to learn something today. If you find something valuable in what I'm teaching today, really, I'd appreciate if you could hit the thumbs up button. If you haven't subscribed, I appreciate if you could do that too. Just lets YouTube know, lets me know that you like the content and that you'd like to continue seeing it. All right, so let's get this U.S. legal disclaimer out of the way quickly, and we'll be back in about 42 seconds, I think. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. And this is IWM, and on this particular trade, I'm going to be a little more detailed about how I set things up, and then as I go forward through the other trades, I won't be as detailed because I know it's a little tedious for me to do it, and tedious for me too. So, but on this one, I'll try to be very, very detailed, and if, while you're watching this, if you have any comments or questions, feel free to put them in the comment section. I'll do my very best to get back to you as soon as I can. So I trade 7 different strategies, and you'll see today that the different trades I have or had that I got out of, I use different ones. So I'll go through and try to explain each one. So first on deck is IWM, Russell 2000. So I did enter this trade back here on the 13th of January. This is what is called a deep dip buy. And deep dip buy is one of my favorite strategies. I use it all the time. I teach it. I have a video course available at udemy.com. It's in the description of this video. I'll talk a little bit about that later, but if you're interested in that video course, the link's in the description. It's a great course, 9.5 hours of video. So the deep dip buy here on IWM, let's take a look at the black line here. This is the 200-day moving average. This is a very key long-term moving averages that large financial institutions key off of. And so when you get to the 200, a lot of times buyers will come in just because you are at the 200, and it gives you a very well-defined stop. Above the 200, I'm in. Below the 200, I am out. So on the day that I entered the trade, you can see during the day we went below the 200, but we recovered at the end of the day and closed back above. And for my swing trades, I always wait for the end of the day before I make my decision. And the reason that I do that is that the large financial institutions come in at the end of the day. They move things around above levels, below levels. They are dealing with the most money. They have very smart people. They have best technology, very good information. And so the end of the day level, the end of the day price, in my opinion, is the most important price for me to make my decision. So with that, on the 13th of January, like I said, during the day, we went under the 200 and then we closed back above the 200. So that was a rejection of the 200. And so that is the primary reason that I took the trade. But I always like to look for confluences, and there was a confluence, and the confluence was that we had a V1 on this day. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 needs to go below the low of bar 1's low and close above the high of bar 1's close. Well, that's exactly what happened. So that was my confluence. Really, confluences are so important. I mean, I will take a trade if it only has one signal, maybe. But really, I try to narrow it down and filter it down to only take a trade that has more than one signal. And the more signals, the better. If the more signals, the more likely it is that the outcome is going to be favorable to you. So I got long at 217.40. Now, as soon as I see the signal, the first thing I need to do is how many shares am I going to buy, or how many shares am I going to short? And this is a formula that I use that has worked well for me and works well for my students, because it's important that you take, when you're deciding how many shares to buy, it's important to look at the volatility of the market. And I do that by using the average true range. You can see here right now, it changes every day, but the average true range is $7.45. One ATR means what is the average expected range of that on any one day. Two is twice that. So if you play, if you're within one ATR, well, the price is expected to move within that. So I want to go outside the expected range, because if it goes outside the expected range, then something is happening that's making it move more than what it should. And so that's where I want to place my emergency stop. So, but first let's talk about the position sizing. So two things. I use the value of the 2 ATR on the day that I took the trade and the value of my account. So today, let's just say I am using a $100,000 trading account. This works on any amount, but I take 1%. 1% of 100,000 is $1,000. If I had a $50,000 trading account, 1% is 500. If I have a $1 million trading account, 1% is 10,000. So if I have a $100,000 trading account, 1% of that is $1,000. Then I simply take that amount and I divide it by the value of the 2 ATR on the day that I took the trade. So divided by 7.45. That would tell me to buy 134 shares. For me, and the way that I trade, that's the correct amount of shares to buy for my account size and the current volatility of the market. So, have a rejection of the 200-day moving average and a V1. I enter at 217.40. Now, the first thing I do once I enter the trade is I place my emergency stop exactly the value of the 2 ATR that I just used below my entry. So if I have 134 shares and the next day it crashes down $7.45, how much have I lost? Well, I've lost $1,000, right? Because I just did the math. So the good news is that your emergency stop is only hit about 5% of the time, in my experience. The other 5%, or the other 95% of the time, if you have a losing trade, it will be your end of bar stop, right? So I always have two stops: emergency stop, end of bar stop. Why did I take the trade? The rejection of the 200-day moving average plus the V1. So the next day, if it closes below the 200-day moving average, I'm simply out of the trade. And 95% of the time, your loss is going to be much less than your emergency stop. Your emergency stop's 1%, but 95% of the time with the strategies that I trade, I'll have an end-of-day stop that is much closer. So now, one other thing I want to say is that if the next day I have to wait for a close below the 200. If it went below the 200 during the day, but then closed back above and recovered, I would keep the trade. So on my end of bar stop, I'm always basing it on the closing price. However, if it gets to my emergency stop, whatever time of the day, whatever time it gets there, I need to get out immediately. Because I'm only willing to risk 1% on my trade. And if it gets down there, I can't wait for the end of the day, because by the end of the day, maybe it's twice that, right? So, okay, a little bit of review then. Intraday rejection of the 200-day moving average, and the V1, I got long 217.40. I position size correctly, taking 1% of my capital, dividing by the value of the 2 ATR that tells me how many shares to buy. I place my emergency stop 2 ATRs below. I place my end of bar stop is just simply, on this particular strategy, a close below the 200-day moving average. Now, the next thing I do after I place my 2 ATR stop, know where my end of bar stop is, I take my entry price and I add the value of the 1.5 ATR. Right now it's 559, and I place that level above my entry price. This is now my trailing stop level. If the price moves up to that trailing stop level, then I go into what is called trailing stop mode. It doesn't mean I take any action. It's just that once it gets there, now I'm in trailing stop mode. And trailing stop mode means that if I have a close below a previous bar's low in the future, I'm going to exit half of the remaining shares that I have. All right, and you can see here 224.10 was my level. So far, the position sizing, the end of the emergency stop, the end of bar stop, getting to trailing stop level, these are all defensive maneuvers. If the price moves against me, I take action. But I also like to play offense in my trading. And the way I play offense is I take partial profits if it moves up a certain amount from the previous bar's close. Not all, just partial. And so this is an actual trade that I have here. And let me show you how I do that. At the end of every day, I look at the closing price. Right now it's 226.47. And now I look over at the 0.45 ATR. 0.45 ATR, right now the value is $1.68. So I take my closing price, 226.47. I add the value of the 0.45 to it, 1.68. So my first profit target for Monday is 228.15. And if it gets there, I will take off 10% of however many shares that I have remaining. And I place 3 profit targets every day. So again, closing price plus the 0.45 ATR, which is now $1.68. My first profit target for Monday is 228.15. Then I take 228.15, my first profit target, I add it again. My second profit target for Monday is 229.83. And if it gets there, I'll take another 10% off there. And then I'll do it one more time. Second profit target, 229.83 plus 1.68. And my third profit target for Monday is 231.51. And I just place the limit orders in the system at those 3 profit targets. If the market just goes down on Monday, well, I'm not going to hit any profit targets. And I'll start again Monday night, taking the closing price, adding the new value of the 0.45 to it for the next day. But a lot of times I'll hit 1. If it's a nice day, I'll hit 2. If it's a great day, I'll hit 3. I've hit up to 7 on a really big, skyrocket move up. But I'm not going to take the time to put in 7 every single day for every position because it rarely happens. So 3 is kind of my ideal, because you do hit 3 sometimes. So, all right. So let's again, intraday rejection of the 200. I got long at 217.40. Position size correctly, as I mentioned, placed my emergency stop 2 ATRs below, end of our stop closed below the 200, have my 1.5 ATR trailing stop level up. Next day, it moved up at least one value of the 0.45 ATR. I took a little profit off. The next day, up big. I believe I hit 3 profit targets, if memory serves correctly. So I'm taking profits into the move up. I'm reducing my position size. I'm locking in the profits. The market can't take it away from me. So if we have a big reversal, it mitigates any loss because I'm taking profits in there. On the 15th here, I also got to trailing stop level. So now I'm in trailing stop mode, which means that in the future, if I have a close below a previous bar's low, I will take off half as a precautionary measure. Next day, move sideways, no profit targets. Next day, gapped open again, took some more profits off. Next day, up again. I believe I hit 2 profit targets on this particular day. So again, I'm taking partial profits into this. Sideways motion, basically no profit targets, no profit targets. Here on the 27th of January, we closed below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had for a gain of approximately 4.35 but I still have half. I love taking half, everyone. I love taking half because it's one of the only win-wins in trading. If it keeps going up, I'm happy that I have half. If it goes down, I'm glad that I sold half. And this reminds me, a friend of mine bought bought Bitcoin at $4. Believe it, $4. And he was asking me my opinion. He's like, I'm not sure if I should buy here, sell here. I said, take half. If it goes down, you'll be happy you sold half. If it goes up, you'll be happy. I talked to him the other night, and he said, yeah, I wish I'd have taken your advice. Because you know where it is now, right? So anyway, but the point is here that that's why I take off half. Okay, so after that, we just moved sideways. We moved up here, no profit targets on Thursday or Friday, and we closed down here. So far, this particular trade, the remaining shares that I have are up 4.02%. Now, if in the future, if it keeps moving up, I'll continue to take partial profits. Right now, we're at a 50-41 RSI level. If we get to the 65 RSI level, then I have other rules that kick into place. If we get to the 70 RSI level, then I have other rules. If it just keeps going down and closes below the 200, what will I do? I'll just completely get out of the trade, right? So you have to have rules regardless of the trade. If it does this, then I'm going to do that. If it does that, then I'm going to do that. Do this. You have to have a process that guides you and gives you a blueprint and a roadmap of what to do. Because if it's just left up to you any day, I feel like getting out here. Why? I don't know. I just feel like getting out. I feel like getting in here. Why? I don't know. I just feel like getting in. It's fun. It's exciting. But if you want to make money over the long run, everyone, get yourself a plan. And if you don't have one, good luck, really. And I teach private one-on-one lessons in the evening time via Skype. I teach all 7 of the different approaches that I have. It's a 15-hour course. I'm very happy to have you as a student. I will teach you everything, all the strategies that I have. They're all quality strategies, good risk to reward ratios. They're all process driven. And I'd be very happy to teach you. And my email is in the link of the description. Just send me an email. We can start a conversation. And like I said, it's a serious course. It's 15 hours. But when you're done with that course, you will have a really good skill. But whether you learn it from me or whether you learn it from someone else, you got to find yourself a process. Really, without it, really, there is no hope. So keep that in mind. So, okay, so that's IWM, took off half for a gain of 4.35%, and then the balance at 4.02%. Okay, next trade, INDA, which is the India stock market. Okay, this is a different trading strategy. This is what is called an abandoned baby. Now, if you want to learn more about abandoned babies or island reversals, they're the same thing. It's just that abandoned babies are 1 bar, island reversals are 2 or more bars. You can go to my YouTube channel. I have a video there that you can watch on this, and they're one of my favorite approaches. So let's go all the way back here to the 13th of January. You see this red bar that I've highlighted in green? That is an abandoned baby. Why is it an abandoned baby? Well, because the previous day we gapped down. Right? We gap down, but very next day after, we gap up. Why is that important? It's important because the market is showing you that things went very bearish overnight to bullish overnight. Why is that important? It's important because it was a sudden change in sentiment from bearish to bullish. And when that happens, more often than not, when you look out into the future, you will see prices higher about 70% of the time. About 30% of the time, they will be lower. This is an example right here. These 2 bars, that's an island reversal. We gap up, gap down. That's showing you that in the future, you're probably going to be lower, and it was certainly right, wasn't it? But this one says in the future we should be higher. So I got long here on the 21st of January. Why didn't I buy it here? I could have, but when I see these, very often what you're going to see after a bullish abandoned baby, you'll see a bit of a pullback before it resumes its move up. And I like to use the high of the abandoned baby as my entry. And so I didn't take any action until here. On this particular day, on the 21st, we came down, bounced off the top of that abandoned baby, and I got long at $50.83. Now, with abandoned babies or island reversals, I don't have the trailing stop levels. I don't take the partial profits. I only have two important points. When I enter, I place a 2 ATR stop below, and I place a 4 ATR profit target above, and I put it in as a one cancels the other order, and either one of two things is going to happen. One, I'm going to lose 2 ATRs, which is 1% on my account, or I'm going to hit 4 ATRs, which would be a 2% gain. And so I like to mix things up with my strategies. And on the abandoned babies and the island reversals, they really are so strong, in my opinion, in my experience, that I just kind of set it and forget it. So I got long here at $50.83. Again, I place a 2 ATR stop here, a 4 ATR profit target here, and one of the two things is going to happen. And so the next day it went down, then we moved up, looked pretty good, and then things started to look bad. But you see how we did not get to my stop level yet. And then what was this? On the 29th, we formed a bullish island reversal. I got in because of the abandoned baby, but this is an island reversal. We gap down, sideways, gap up. So I was very glad to see this. This was bullish for this position over here. And then we started to move up. Again, I'm not taking partial profits on these, either 2 ATR stop, 4 ATR profit target. Friday was really good. I mean, it really started to move up, and then we reversed. So this particular trade up a little, up a teeny bit, up 0.31%, but feels like a lot more than that since I was negative on the trade on these 2 days dramatically, and I almost hit my emergency stop, but rallied for there, so I'm glad. So this is an abandoned baby, and then this is a island reversal. And again, if you go to my YouTube channel, I did a whole video on this approach, and I really do like these. So INDA up 0.31%. Okay, Shopify. This is a short position, and I took this trade on Thursday, on the 30th, and this is what is called an order block. This is another one that I use and I teach, and you can see the red box here. Whenever you see red, I'm most likely going to be shorting into that red area. And this is called a bearish order block. And let me take you back here to the 17th of December. See the up bar? Well, this is your highest up bar close before market structure change. This day on the 18th of December, this changed everything. Why? Because this big emphatic down bar took out these swing lows, changing us into a bearish market structure. And so the shortable area of an order block, again, remember the order block's the highest up bar close before market structure change. The high here is 119.85. The low is 114.95. I don't short here when this happens. I wait for the check back. I wait for the counter rally back to it. So look at this. So we basically touched the bottom of that, and that's exactly where we sold off. I didn't take the trade here. But I took the trade on Thursday because we tested the high of this order block, and my risk to reward ratio was really good because my end of bar stop is simply a close above this high. So I shorted there 119.20. I placed my emergency stop by position size correctly. I placed my emergency stop 2 ATRs above. My end of bar stop is very close with simply a close above 119.85, which is the high of the order block. And then I placed my 1.5 ATR trailing stop below because I am short. And then on yesterday, on Friday, we gapped up. We were way high. I was like, well, I'm going to be stopped out of this trade for sure. But again, I wait for the end of bar close, and it reversed, keeping me in the trade. And this particular trade right now is up to 2.11%. So Friday, I'm sorry, Monday or next week, again, if we close above the high of this order block, 119.85, I'll just get out of the trade. I did hit one profit target already on Friday, so lock that in, reduce the position size a little. And going forward, if it keeps moving down, I will continue to take partial profits. If it gets to my 1.5 ATR trailing stop level, then I'll go into trailing stop mode. And because I'm short, what this means is now I'm in trailing stop mode. If I have a close above a previous bar's high, I will exit half. Make sense? So anyway, big reversal on this particular trade, and this one, this short position on Shopify up 2.11%. Okay, so those are the three open positions. IWM, remaining shares up 4.02%, INDA up 0.31%, Shopify up 2.11%. So now let's get to the closed positions. So this is gold. So this is a good example, everyone. I'll explain. Over here on the 30th of October, we had an order block, just like on Shopify. It was our highest up bar close before market structure changed to the downside. Therefore, if I get back up to the order block, I am going to short. Well, that's exactly what happened on the 24th of January. We rejected the bottom of the order block, and I got short at 255.60. I placed my emergency stop 2 ATRs above. My end of bar stop is a close above 257.51. I placed my 1.5 ATR trailing stop level below. The next day, nailed it so far when I took the trade. Went down substantially, took a couple profit targets, and I also got to trailing stop levels. So that's why taking the partial profits is so important, because look, I short here 255.60. Next day really collapsed. I think I hit 3 profit targets, so I took 30% of the trade off, which ultimately was a really good idea because I ended up on the balance getting stopped out. And then I also got to trailing stop level, which means what? It means if I have a close above the previous bar's high, I'm going to get out of half. And that happened the very next day. Reversed right back up. Bullish Bantam Baby, by the way. Gap down, gapped up, right? So I took the profits here. Then I had my first close above a previous bar's high after reaching trailing stop level. So I locked in half. I reduced half of my position for a gain of 1.4%. It's not a lot, but based upon what happened in the future, I'm really glad I did that, right? Because the next day went down again, took another profit target at a profitable position, and then on Thursday we gapped up and just closed above my stop. So the remaining shares that I had, I got out for a loss of 0.9%. But did I lose 0.9% on the trade? No, I did not, because I took off profit targets when I had them with the partial profits. I had the rule of the trailing stop rule. That saved me a lot. So all in all, it was a little bit of a losing trade, but not by much. And that's why these rules that I use are so important, because if you have a market that just goes up and up and up and up, you're like, oh, well, that was dumb, taking partial profits, trailing stop, and all this. Well, it doesn't happen very often. The market only trends about 15% of the time. 85% of the time, it goes up and it goes down and it goes up and goes down. And that's when that's why the rules that I have here for my process really work. The trailing stop levels, the taking partial profits. So, but the remaining shares that I had on gold, loss of 0.9%. All right, then ARK, ARKK. All right, this is a really interesting trade. And again, this shows you the value of taking the partial profits and the trailing stop rules. So back here on the 16th of December was our highest bar close before market structure changed. Therefore, I want to short the rejection of the bottom or the top of the order block. I got short here at 61.12 on the 6th of January because of the rejection. Placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs. I placed my emergency stop 2 ATRs above and my 1.5 ATR trailing stop level below. The next day just collapsed. Took a lot of profits. I think I hit 3 profit targets on this day. The next day went down more. I took more profit targets and got to trailing stop level. The next day went down more, got to took more profit targets. The next day here on the 13th, again, reduced my position size again because of the partial profits. And then because we are at trailing stop level here, when we closed above the previous bar's high, I had to exit half of the remaining shares. And honestly, I didn't have that many shares left because this was such a big down move. I just kept taking profits and profits and profits and profits. And then here with the first close above the previous bar's close, I locked in half for a gain of 4.46%. And then we went on this straight up move here. And then on the 24th of January, we were above my stop, closed below, kept me in the trade, gap down that next day. I took 3 more profit targets on this move down. Again, at profitable levels. And then we went straight up. And on the 30th, I had to exit the remaining shares that I had. For a loss of 3.76%. But again, did I lose 3.76%? I did not, because of taking all the profits that I did here, exiting half of everything here, taking more profits here. But again, just a good example. But I did have to get out, and then on Friday it closed lower, but that's okay. So remaining shares down on that short 3.76. So the exited trades, gold lost 0.9%, ARK lost 3.76%. So those were the open dailies and the closed dailies. Now let's go to the weekly bars, the weekly trades. Weekly trades start on Friday because the weekly bar closes on Friday. And let's start with Home Depot. So Home Depot, this particular trade is based upon what is called a return to value V1, V2. Again, another strategy that I use, another strategy that I teach. Let me bring your attention to the 2 green lines here, the top green line and the bottom green line. This is the value zone. Anywhere below the top line, anywhere above the bottom line, it's called the value zone. In general, I want to buy in the value zone and sell above the value zone. Or I want to buy below the value zone and sell in the value zone. A lot of traders, especially retail traders, they chase these moves up here above the value zone. You'll very rarely see me buy anything above the value zone. I want to buy in value, sell above value. I want to buy below value, sell in value. This is what was taught to me by Dr. Alexander Elder, because I studied with Dr. Elder one-on-one, and he really ingrained that into my trading brain. Don't buy above value. So with that being said, when Home Depot was up here, I didn't want to buy above value. I wanted it to wait for it to come into value. Well, here it came into value. But just because it comes into value, it doesn't mean I immediately buy it. I need 3 things to happen. 1, I need it to be above value. That happened. Check. 2, it needs to come into the value zone. That happened. Check. The third is that I need at least 2 bars of sideways motion, or in other words, it doesn't just keep going down. I need there to be sideways motion to show me that there's an equilibrium of buyers and sellers. And so when all 3 of those conditions happen, close above the value zone, close back into the value zone, and then sideways motion. When those 3 things happen, then if I have a V1 or a V2 entry, that is the legitimate entry for me to enter the trade. And that happened here on the 10th of January. V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below the low of bar 1's low, closes above bar 1's close. So I entered at 389.85. Position size correctly, place my emergency stop 2 ATRs below, and now your end of day stop, or in this case end of week stop on Home Depot, is simply a close below halfway of the washout bar. And this was the washout bar the day that I took the trade. And by the way, if you want to learn more about V1s, V2s, again, I have a video on YouTube where I go into detail about them. So the return to value sideways motion V1 got me long 389.85. My 1.5 ATR trailing stop level is 1.5 ATRs above. The next week took off like a rocket ship, which was great. First week got me to trailing stop level, and I hit profit targets, reducing the position size. Since then, we haven't done much, but I am in trailing stop mode. We did not close below the previous bar's low, so I'm not taking off half, and the remaining shares that I do have on Home Depot up 5.17%. So nice example, return to value, sideways motion, V1 entry. That's worked really great so far for 5.17%. TLT, another weekly trade, TLT or bonds. Now, I've shown you a lot of red boxes above. So those are shortable areas. These are green boxes. So this is a bullish order block, just the opposite of a bearish order block. Back here on the 20th, lowest bar close before market structure change. Therefore, if we get back to the green, that's the buyable area. And I got long here on the 17th of January at 87.18. Why? Because we rejected the order block. See how we came into the order block, then we went back above? So I got long here, 87.18. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade is a close below 85.70, and you might ask, why that area? Well, if you go all the way back here to the 3rd of November, we had this big up bar. If you have a big up bar, you're going to have some type of inherent support at halfway of that. So I took the halfway of this big bar on the 3rd of November out into the future, and that is my end of bar stop. So the trade's up a little, not a lot, but rather be up than down, right? Up 0.6%, have not got to trailing stop level, haven't taken any profit targets, just hasn't done much yet. But as long as it stays and closes above 85.70, I am bullish. And again, it was the rejection of the order block, the bullish order block, and the V1. Here's the V1. See, bar 1, bar 2 goes below bar 1's low, closes above. So that is TLT. And then lastly, I did enter a trade on Friday on DDM. DDM is double leverage Dow. I did get short. Why? Okay, you see a red box? That's a bearish order block. Here is our highest up bar close before market structure change. Therefore, I want to short checkbacks and rejections of that order block. And you can see on Friday, the weekly bar did test the low of the order block and then close below it. I got short 103.70, basically break even, got in at the end of the day, position size correctly, placed my emergency stop 2 ATRs above, And my end of bar close is simply a close above the high of the order block at 107.53. This one's basically, yeah, I'm down just a bit. 103.70 to 103.86. So just down slightly, but basically break even trade. So that's it. If we close above the order block, I'm out. If we go down next week, I'll take partial profits. If we get to trailing stop level, then I go into trailing stop mode. But again, I know exactly what I'm going to do regardless. Worst case scenario, it hits my 2 ATR emergency stop, I lose 1% of my account. Only about 5% is that going to happen. Closes above the order block, I'm out. If it goes down, take profits, right? So again, process driven, you need the process. So on the weeklies, recap of the weeklies, Home Depot up 5.17%, TLT up 0.6%, and DDM basically break even because I just took it on Friday. So those are the trades, the open, the closed, and the ones that I got out of. So again, I hope that was helpful for you. If you have any questions on any of those trades, please let me know. Okay, before we get into the potential trades for next week, let's take a look and do a little trader psychology. This is from my good friend Stephen Burns. You can follow Stephen at @SJosephBurns over on X. This is the New Traders Rich Traders forum on Facebook as well. Steve's a great trader, great author. He has great books on Amazon, so try to check those out. Read every single one of them. I have. So let's see what Steve has to say here. Cash is a position, FOMO is expensive, and patience is an edge. Very simple, but really so true, everyone. Let's start with the first one. Cash is a position. There's 3 legitimate positions in trading: long, short, or cash. And they're all legitimate. If there's not a signal out there, if there's not a trading signal, a legitimate entry for a reason to be in a trade, either long or short, the correct position is cash. Remember that. Studying with Dr. Elder, he taught me that as well. It's just as legitimate as long and short, and don't feel bad or like you're not doing anything if your position is cash, because if you have a good trading approach and a good trading process, you're not going to be in a lot of trades because you don't have a lot of really legitimate trades. So the correct position at that time is cash. FOMO is expensive. Well, that's certainly true. We're herd animals, everyone. We like to follow the herd. And I was telling you on that return to value V2 trade on Home Depot that I don't like to buy above value. Ever. Really ever. And anytime there is FOMO going on, things are going up, you are well above that fair value zone. And so I have to resist the urge to get into a trade that everyone's going into. And yes, sometimes they go up and they go up for a long time. And I don't participate in those trades, right? You can't have everything. But a lot of times those moves up significantly above the value zone are going to come back. So FOMO happens because the headlines are good, the news is good. You're like, you hear, oh man, this stock's going up and up. Why am I not in that? Don't chase it. Wait for it at the very least to come back to the value zone. It's always going to come back to the value zone, by the way, at some point, right? It's always going to come back. So try not to fall into the trap of FOMO. I have a good friend of mine, trader friend, yesterday. She told me, I didn't think I have FOMO, but I do. It affects everyone. We are herd animals. It affects us. Oh, the herd's going that way. We should probably be in. A lot of times in trading, you have to go against the herd. So remember, FOMO is expensive. Don't fall into it. And patience is an edge. If you could sum up trading in 4 words, this is it. Patience is an edge. Large financial institutions, they have to be in the market all the time. We as individual traders do not have to be. We can be in when we want and we can be out when we want. That is our number one advantage. And when we get in, we can just get in. We get out. We just press a button, get out. Large financial institutions, with a lot of stocks, they can't just get in and get out. They have to wait for the volume to be there for them to get in or get out. And they always have to be in the markets, right? But we don't. We don't have the computer power. We don't have the manpower. We don't have the the intelligence. I don't mean you're not smart, just the intelligence of, what the word on the street is and people sharing information and so forth and so on. We don't have any of that. But what we do have, and it's our number one edge in trading as small retail traders, we can get in and get out when we want, and we don't have to be in. We can be in cash when we want. And that is the number one advantage that we have. And so this goes back to patience. Patience is an edge. Like I said, when we're going to get into the potential trades for next week, I don't have to be in the trades. I can look at the charts and go, if Microsoft does this, that, or the other, that's when I'm going to get in. The large financial institutions, they really can't do that. It's a huge edge for us. So remember that. So cash is a position, FOMO is expensive, and patience is an edge. Alrighty, let's get on to the potential trades that I'm looking at for next week. Now, here on the daily time frame, I have 9 particular possibilities for next week. And I always like to mention before we get into this that it's theoretically possible that all 9 of these could trigger on the same day. And does that mean I would take all 9 positions in the same day? No. I have a rule. I only take 1 position per day, regardless of how many valid entries there were that day. And the reason that I do this is that I like to take the best. Out of 9, if they all trigger, there will be one that is better than the other. And how do I decide that? I decide that by several different factors. One, what is the risk to reward ratio? One of them is going to have a better risk to reward ratio than another. 2, how many signals or confluence of signals happen on that day? Maybe one triggered one particular stock had 2 signals, 2 entry signals. Maybe one had 3, maybe one had 4. Of course, I'm going to take the one that has the most signals. I'm also going to look at multiple time frames. I'm going to look at a higher time frame and see if I can find some support or actual signal on a higher time frame. So if I'm trading the daily, I want to look to the weekly for more confirmation. And then lastly, I want to look at the relative strength of that particular market. Maybe the market was down in general on that day, but one of these was up plus had all the other signals. That is the one that I would choose to take. And so, this is what I teach my students in my one-on-one course, how to differentiate and give a higher quality score to one particular possible trade compared to the rest. Really, the devil's in the details in trading, and it's important that you can give a report card or a score and take the one that has the highest score. And so keep that in mind. Okay, so first on deck is AMD. So when I went through my watch list last night, the thing that brought my attention to AMD is you see how we're going lower and lower, yet the MACD, these are the red bars, this is a measure of momentum. Here, deep red MACD bars. Here we're lower, less MACD bars. Here we haven't made a new low, but we have no red MACD bars. So this is what brought this onto my radar. This is what's called the double bottom with the bullish MACD divergence. Now, by itself, it's not an entry signal, but it's big picture. What's happening here is every down move from a MACD perspective is getting less momentum, less momentum, less momentum. And this is showing me that the selling momentum from a MACD perspective is getting less and less and less. It's just another way to say, from a MACD perspective, we are running out of selling momentum. And if you run out of selling momentum, the implication is you are going to start going up. If you run out of sellers, you're going to go up. If you run out of buyers, you're going to go Really, that's as simple as it is. And that's why people use MACD as an indicator to get long. But again, just by itself, it is not an entry signal. It's just a big picture lay of the land that's showing me, hey, I should be looking for an entry signal. So, we're going lower and lower on less strong and less strong MACD. So let's talk about an entry signal. Where would an entry signal be? Well, the way that I trade, you see the swing low that we have here and the swing low that we have here. If you connect these two bottoms and you run them out into space, this is a channel. This is like a channel entry. If we come down and reject this channel, that would be a potential entry signal for me. In addition, we're at a 40.64 RSI. Well, from a deep dip buy strategy perspective, an under 30 over 30 is a legitimate signal. However, I like to look for the confluences of signals. Well, the double bottoms, the MACD, bullish MACD divergences, in addition to an under 30 over 30, there's your confluence. That's what I would be looking for. But we're still at a 40.64 RSI. So that has not happened yet. So if an under 30 over 30 happens, I would definitely consider getting long AMD. Conversely, if we come down, reject this channel line, that would also be a signal. And then I would use the channel line as my end of bar stop. So if it rejects it, and then the next day it closes under it, I would get under. But just my experience, this is showing me that we are having some potential buy signals here in AMD. I mean, if you look at AMD, we've lost 50% on AMD. This is a monthly chart, but we have lost we've had a 50% retracement. We had earnings, rallied after earnings, sold off with the rest of the market on Friday, but I'm definitely interested in buying AMD. Keep in mind, I am buying, if we get there, that's buying under the value zone. Again, just an example, look at everybody chasing FOMO above the value zone. Was a good place to buy? It certainly was not. And here we've been under the value zone for a while, really no signals, but I'm going to be watching AMD carefully next week again with an under 30, over 30, and a possible rejection of this channel line. And the channel line dovetails right with the negative third ATR channel, which is also nice. Because 92% of prices when they get to the negative third ATR channel tend to at least bounce. And so this is dovetailing with the negative third ATR channel and the channel line as well. And if we could get those all lined up with the 30 RSI, that would be ideal. And again, we have the MACD momentum indicator getting less and less and less, showing us that we are running out of sellers, essentially. So that's what I'm looking for next week on AMD, under 30, over 30, or rejection of that channel line. Caterpillar. Okay, I really like this trade, everyone. I really like this. I don't know if we're going to get there, and if we don't get there, I won't take the trade. But if we do get there, I am definitely interested in this. So let's look at the black line here, 200-day moving average, deep dip buy, right? Well, look at the last time we went under and back over the 200. Simple. That was a legitimate signal. I didn't take that trade. And quick quiz, what was the signal? Under, over 200, and a V2. Bar 1, 2, 3, 2 goes under bar 1's low, 3 closes above bar 1's close. Nice trade. I didn't take it, but great trade. Now, this, the level that I'm looking at is the 200-day moving average here. Right now, the 200-day moving average is 358.80. We're at 371.44. Am I super excited just because it's the 200? Well, I like 200s. I like deep dip buys, but what I really like about this trade is, let's go back here to the 10th of January. This is your lowest down bar close before market structure change. So in other words, that is a bullish order block. Well, look at if we get down to the top of that order block, we should have some type of support there from a bullish order block perspective. But look how the high of the order block dovetails almost exactly with the 200-day moving average. Do you see that? That is a massive confluence. Rejection at the top of the order block is legitimate just by itself, but it's even better because of the 200 being right there. So I'm going to be watching Caterpillar very carefully for rejection of the 200, because if it rejects the 200, it's also going to reject the top of, or the high of the order block. So I really like this potential trade. I don't know if it will get there though, but if it does, I'll very likely be taking this trade. Intel. Okay, so Intel has been a really interesting trade for me over the last many months. If we go all the way back to the 7th of August, we had a down bar close, market structure change. I want to buy in the order block. Bought right here with the V1 rejection of the bottom of the order block, had a really nice trade on that. Then back here on the 10th of December, another trade in the order block, under 30, over 30. I really had to gut this one out. Stayed in the trade, caught this move up. My rules taught me to get out there, and that's where I got out of the trade. Luckily, now we are getting back in that buy area. And ironically, I was talking to a trader friend of mine. We have two order blocks going on at the same time. We have the green order block from back in August, and we have a new order block in the blue here, because here in the more recent we changed market structure again. So the light, or the blue, is an order block, the green is a longer term order block, and so I am really looking to get long on Intel here. We were up on Friday and then it reversed with the rest of the market. The key level right now is the $18.90 mark. You can see we tested it here, bounced here, tested it 3 days here, bounced here. Will we do it again? I don't know. I don't know if we will or not, but the 1890 mark I would look for. So two things I'm going to look for. I'm going to look for a rejection of the inside order block. The low is, where's the low? 1903. That's the low of the most current order block, 1903. So if we come down, reject 1903, go back above, very likely I would consider getting long. Or conversely, if we come down and test the other order block at 1890, same. I mean, they're pretty close, right? I mean, they're within 5-10 cents of each other. So essentially, I'll be looking for a rejection of the low of 1903 or a rejection of the low of 1890. You know, what happened with the market on Friday was interesting. It seemed like things really changed. By the way, I am going to go over the SPYs and the Qs, just kind of give an overview. But that's what I'm looking for on Intel, is a rejection of one of those order blocks as well. Because every time we've got here, it has held and has bounced. There have been buyers that have come in. I mean, look all the way back in the past. I mean, I don't think you can argue. Whenever we've got to these levels, bounce, bounce, bounce. It's going to happen again here? I don't know. It doesn't have to, but I think it's more likely. So I'll be watching Intel. Southwest Airlines, love. Not given a lot of love on the market here, but there are a lot of confluences and a lot of major moving averages on love at about, what is that, 29.30. We're not too far away from it, really. We're not too far away at all. We have the 250-day moving average, we have the 200-day moving average, we have the 300-day moving average. We're at a 35.42 RSI. Whenever you get a confluence of a major moving average and a 30 RSI level, is generally a good risk to reward entry. And the nice thing about the moving averages is they give you a very defined risk to reward. Above the 250, I'm in. Below the 250, I'm out. Above the 200, I'm in. Below the 200, I'm out. So I would imagine that there are going to be some buyers, institutional buyers, coming in at this area, but I don't know if it will hold. But the confluence is there. Under 30, a 30 RSI level, low 30 RSI level, and a major moving average. That's what I'm looking for. So if it gets down here, I think that will really be an interesting location. Look, last time we were at the 200 here, look, tested it. That was all she wrote. And I mentioned in the past about the golden cross, the 50 crossing the 200. Look, 50 crossed the 200 here. Usually the first check back to the 200 after the cross is a good area to buy. That nailed it. Will it be this time? I don't know. But when you have these major moving averages group and kind of gel together at the same location, that shows you that there will probably be some buyers here, but it may not work. We may reject the 250 or the 200, and then just some new information might hit the market and we might close under. We have to be prepared for that. But that's what I'm looking for next week on Southwest Airline: rejection of the 250 or the 300 or the 200, and ideally a rejection 30 RSI. But this is a full-on deep dip buy that's all nesting here together. So I'll look for a rejection of one or more of those moving averages next week. Microsoft. All right, well, Microsoft's been kind of a hot mess, hasn't it? But we are getting into some major key moving averages. We've lost the 200. We have bounced at the 300. It held here on Thursday. Did it hold here on Friday? Yes, it did hold here on Friday. I'm a little scared of the big down bar move. Ideally, what I'm looking for here would be a rejection of the 30 RSI. Right now we're at 40.47. So if we go down lower, a rejection of the 30 RSI would be around this area. That would also have a confluence with the negative third ATR channel. That's nice. And then also from a MACD perspective, we are going to have a double bottom with a with a bullish divergence, because look at the lows here. Look how deep the red MACD bars are here. We're almost as low here as we are over here, but yet the MACD bars are not as deep. So that's the confluence. Remember, I'm always looking for the confluences. The confluence is that we will have a double bottom bullish MACD divergence, but it's not enough for an entry signal, but it is a big picture. It is very bullish, but we need the signal. What would the signal be? Under 30, over 30. Ideally, if we go under 30, over 30 in rejection of the negative third ATR channel, overlaid upon the double bottom with the bullish MACD divergence, that'd be great. But Microsoft really got hit on earnings. I'm a little concerned about the 300-day moving average. It might just go from here. I don't know. But if it does, I won't be in it. I want it in this area. I want it closer to $403, $405. So that would be another $12 below. But again, I'm patient. I don't have to be in Microsoft. If the price and the price action is what I want, then I'll get in. If it only does exactly what I want to do. And if you do that and you incorporate that in that trading, have that mindset of being patient and go, I'm not going to get in this unless it does exactly what I want, it will improve your trading. I promise you. So rejection of the 30 RSI, negative third ATR channel, overlaid with a double bottom bullish MACD divergence is what I'm looking for here in Microsoft. NVIDIA. All right, well, it's been a while. It's been a minute since NVIDIA has been at major moving averages, but yet we are here. We closed below the 200, ripped right back above it. Now we are below. What is that telling you? Right now, the market, the 200-day moving average is not being respected. We're above it. We're below it. We're above it. We're below it. So when that happens, that moving average is not being respected. So we have to look lower. Well, 250-day moving average, 300 200-day moving average. We may test those, and maybe that is the moving average that the market will respect. I don't know if it will or not, but if it tests it and rejects it, I'll probably get long. If I lose it, I'll have to look lower to the 300. My guess is that the 300-day moving average is going to be the level. But, a little bit earlier, I talked about, giving a score to potential trades and looking at higher time frames. Look, I drew the line at the 250-day on the daily at 114.70. I drew the line at the 300-day at 103.60 with the 300-day moving average. Now let's look at the weekly time frame. This is a good example of looking at higher time frames. So this was the 250 on the daily. This was the 300 on the daily. Which one looks better to you? To me, the 300 looks much better. Why? Because it dovetails with the negative third ATR channel on the higher time frame. See, this is how I look at the higher time frames. So negative third ATR channel, 92% of prices tend to quit going down, stop going down, move sideways, or bounce here. So this negative third ATR channel on the week dovetails with the 300-day moving average on the daily. Makes sense? So that is why I am really looking for this 300-day moving average as the place that I would love to get long NVIDIA. That being said, if we have good price action and a nice rejection of the 250-day moving average, I would also consider that. But my ideal would be a rejection of the 300, but I'm also going to stay open to getting long with the rejection of the 250. UNG is natural gas. Okay, natural gas, simple deep dip buy, looking for a rejection of the 200-day moving average. Greg, but you like confluences. What's confluence? Well, the confluence is that we had a golden cross. We had the 50-day moving average cross over the 200-day moving average, and therefore, when that happens, usually the first check back and rejection of the 200 is a good entry point. So I'm looking for UNG with rejection of the 200-day moving average. The confluence is that we have the golden cross prior to that. That's usually a good. But regardless, it gives me a good risk to reward ratio. Bullish above 200, out below. Oil, USO, similar. We just had the golden cross, 50 crossing over the 200. Therefore, any check back to the 200 after the golden cross has happened is generally a good risk to reward ratio and gives you a higher than average probability of the trade moving in your favor, but not 100%. So on oil, USO, I'm looking for a bounce at the 200. And then last but not least on the daily is Exxon. Exxon has a bullish order block here. Here is your lowest, here on the 19th is your lowest down bar close before market structure change by taking out this swing high. Then you see we check back, then we bounce. Well, we're back in it right now. We did have a market structure change here on the 29th. I didn't take that one because the risk to reward ratio was a little bit big and we had that big down bar previous. So what I'm looking for on Exxon is a rejection of the bottom of that order block. The bottom of the order block is 105.21 roughly. So that would potentially get me in the trade. Alternatively, if we had inside the order block, if we just had like a V1 or a V2, I would potentially take that. But we have earnings coming up on the 7th. So, if that happens, I may only be in the trade for 1 or 2 days, right? So let's see, the 7th that puts us in the next week. That's Friday. Yeah, that's Friday. So for me to really get into this trade for any length of time would be after earnings, but still, if this happens before earnings and we get a rejection of the bottom of the order block, I may just go ahead and get in there, but only be in the trade for 1 or 2 days. So those are the daily trades, potential trades, and then weekly trades. I only have one, but it's AMD again. I had it on the daily, and I also have it on the weekly. I've been talking in the podcast. I've been talking about this AMD 200 trade for a while now. It did reject here. Could have taken it. I didn't take it. Here, technically, could have taken the trade as well, because intraday we went, or intra-week we went below the 200 week moving average and closed back above it. Why didn't I take the trade? Earnings were out of the way. Well, I didn't take the trade because there's no confluence. All it was an intraday rejection of the 200-week moving average. I mean, it's legit to take. It's 100%. It's legit to take that trade. But again, remember, I like the confluences. What could a confluence be next week? Well, if we go down this week on AMD, maybe we go down at the beginning of the week, and then we reverse at the end of the week, that would give me another rejection of the 200-day moving average and maybe a V1, something like that. But this is a good example of, yes, this was legitimate, just as it was on Friday, but for me, there really was no confluence. If there was a double bottom bullish divergence, something like that, I would have taken it. If it would have been at the negative third ATR channel, I would consider taking it. If there would have been a V1 along with it, I would consider taking it. But just by itself there, even though it's a really good risk to reward ratio, I'm not going to take it. So by next Friday, maybe I take it already on the daily, right? Maybe we get there, reject that channel line on the daily, and I'm already in, and then I'm on the daily trade instead of the weekly trade. But if it doesn't do that, again, if maybe I would need a V1, I would need really a V1 or an under 30, over 30. Maybe it comes down here to the 250 week moving average. Under 30, over 30 plus a rejection of the 250, that would be better. So some kind of confluence to the upside, like a V1 close back above the 200, or if we go lower, rejection of the negative third ATR channel, rejection of the 250-day moving average, and maybe a rejection of the 30. So yeah, I mean, ideally, that would really be the spot on the weekly, but I'm open to the 200 as well. So that's all I have on the weekly. I hope this podcast has been helpful. Oh, I forgot. Let's talk about the SPY and the Qs before we call it a day. Here we go on the Qs. So this is kind of interesting. A lot of things going on here. Back here on the 16th of December, we had a big up bar followed by structure change, right? So this is your bullish order block. Then we have structure change. In the blue, bearish fair value gap. In the red, order block. Well, you can see we cracked down. We got into there, into the fair value gap. We failed. We tried it again. We failed. Then we had this huge up bar move. We got into the order block area, and that's where we stalled. Here on the 27th of January, we created an island reversal. We gap up, 3 days sidewards, gap down. Therefore, if we then go back up into the into the bearish island reversal, that's probably where we're going to fail. It's exactly where we failed. So going higher is going to be difficult. I think the highs are in, honestly. I think the highs are in after this. Every time we've gotten up here, we have found sellers. We're going to have to go lower to find buyers. We, connect the bottom here, connect the bottom here. We may have some buyers here, maybe in the 515 range. So, we could have 7, 10, 15 points more to the downside, right? I wouldn't be excited about buying up in here. So, but this is just a good example of bearish order blocks, bearish fair value gaps, bearish island reversals. It's funny, I had someone message me on Friday and saying, well, apparently the Q doesn't care about the bearish island reversal. Well, it did, right? I mean, I know there was news, but sometimes it's interesting how news happens right in these technicals. But just on face value, we got into the bearish island reversal and failed. I think we're going to have a real problem getting above this area. I would look lower to this potential trend line for a bounce. If we go over to SPY, really the same thing. It was a little stronger than the Qs, but here we have the bullish order block, market structure change. We get back into the fair value gap. We fail. This one actually got above the order block, which was really interesting to me. But regardless, we created the bearish island reversal. We gapped up, a few days sideways, gap down, any move back up into these areas, you're going to find resistance, and that's exactly what we did. And if you look at the trend line on SPY, when you connect these bottoms, we actually failed and closed below it on Friday. So I would be looking for lower areas for the first real bounce on the SPY. So I would be careful getting along those indexes. But I could be wrong. I am often wrong, but I'm often right too. So basically, just be careful right now. The technicals on the indexes do not look good. So listen, if you learned something today, I would appreciate it if you could hit the thumbs up button, subscribe to the channel. If you're interested in one-on-one lessons, like I mentioned before, I teach a 15-hour course, 5 sessions. Each session is 3 hours. That's where you get the 15 hours. I love to teach. I'll teach you everything that I know, all the rules. When you're done, you'll be a better trader. Just send me an email. If you're interested in the Udemy video course on the deep dip buy, I've sold so many of those around the world and have like 4.8 stars or 4.85 stars. It's a great course. It's very affordable. The link is to Udemy is in the description as well. If you have any comments, questions about anything I discussed today, just put them in the comment section. I'll do my best to get back to you as soon as I can. But I hope you have a good rest of your day. I hope you have a good rest of your weekend. Please try to go out and do something nice for someone today. If you can, try to go out and do something nice for an animal. Humans, animals, they all appreciate acts of kindness, just like we all do, right? And it's just a good thing to do. So thank you so much for being here, everyone. Hope you found it helpful, and God willing, I will see you next week. But please be careful. Get yourself a process and follow it. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.